last time mentioned that for a global marginal investor, you would be better off against an all world, and yet we're doing Disney against the S&P.
You can change it in Bloomberg. It doesn't matter. You won't get very different numbers.
Okay.
Because with the S&P, with the U.S. stocks, you won't get very different numbers.
Right.
If you have a German stock or a Spanish stock, you get very different numbers. The MSCI and the S&P 500 are very highly correlated.
Sure.
As you move away, so it does matter,
Right.
and it will matter more and more as we go through, as the S&P becomes a smaller percentage of the global index. So you can actually run your regression against the MSCI global. You go into Bloomberg, the default is always the local index. You can change the local index. So we'll talk a little bit about those processes. Okay. I didn't mean to scare you yesterday with that email, but maybe it was a good thing. I mean, this is the first time, I think, in I don't know how many years that I'm teaching two of the same class in parallel. It's actually an interesting experiment. I'm teaching the undergraduate class later in the day, Monday, Wednesday. It starts a week ahead of this class, so it's in one session ahead of this class. It's like managing two baseball teams at the same time on two different fields, and I'm running back and forth, and sometimes I'm quite confused about where I am. But the interesting experiment is that the median age in that class is 19 and a half. They're getting exactly the same content you are. Okay? But the interesting thing is what you take out of the class will be different depending on what you bring into the class. Okay? So you can look at the same content, and what you get out of it, if you're 19 and a half, is tools and techniques. That's all you care about, because you're going to be low person on the totem pole. You're going to be told what to do. So your job is, how do I get a beta? You don't want deeper stuff, so I'm trying to extract them from the weeds, saying get out of there, because they want to go back in there. With you, it might be the opposite problem. You guys all are CEO material already in some sense, so I've got to get you into the weeds a little bit more. So it's good that I gave you that advance notice, because the first quiz is a week from today. I'll restate the rules even though I went through them. First half an hour of the class, not the last half an hour, not the middle half. So if you come in 20 minutes late, it's over, right? So it's first 30 minutes of the class. It's open book, open notes. I have two other rooms I've got for this class that I will redirect some of you, and it'll be alphabetically based. I'll try to get everybody into every room. Otherwise, people get all pissed off saying, I didn't get into that other room. There's nothing special. It'll be 170 and something else. And the reason I'm doing that is look around you. If you have open book, open notes, and people start spreading stuff out, this room can be a nightmare, because there will not be much room to move around. So I will send out that email. There will be a review session this Friday that I will run. I know not all of you can make it on Friday. It's going to be 12 to 1 on Friday, so I'll send you the room. It's not going to be this room. I don't think I got Paulson. I'm not sure. Okay? But I'll let you know when the review session is, and I'll send you the material. And it'll be good if you have something to review, which means that if you're waiting till the weekend to get started, the review session is not going to be as useful as we get started earlier. So I would suggest starting today, maybe Wednesday, maybe even Thursday, but sometime before Friday. Okay? So I will send you that email. And if you're going to miss the quiz, you know what the rule is, right? What do you need to do? Let me know before the quiz, by 10:28 or 10:29 a.m. And the reason is very simple. I cannot give people the option to take the quiz. Okay? Because the class is this big, you could come to the quiz, screw it up big time, say I wasn't there, and I have no way of knowing, so because I don't take attendance. So you need to let me know before the quiz if you're missing the quiz, right? And if you have something completely unavoidable, you're in an Uber car and the Uber car driver takes you off on a ride to Islip or whatever it is, wherever you decide to go, then let me know that you're in. Now, I will find out. You'll probably be in the news. I'll read your name in the news and say, okay, he's excused or she's excused. So a week from today, it'll cover everything we do through Wednesday. Okay? Any questions? Okay, I want to ask you the standard question. Actually, I will. Who's not picked a company yet? At some stage, people will be too embarrassed to even admit they haven't picked a company. Maybe we've reached that stage. So maybe I can stop asking this question, fully recognizing that about 50 of you haven't picked a company. I just know. I just know it in my heart that 50 of you haven't picked a company. You might have thought about a company. Maybe this morning you read about a company in the newspaper, but you really haven't picked a company. But please do. So let's go back to where we were on Wednesday. I was talking about the Bloomberg Beta page. Right? So I don't know how many of you had a chance to print this page off your company, but it should have got a page very similar to this one. So what I want to do to start this class off is to gather all the stuff I have already for Disney. Remember, what's my end game? I want to come up with a hurdle rate for Disney, right? So we talked about risk-free rates. We've talked about equity risk premiums. We've talked about betas. We're ready. We can bring those numbers together to come up with an expected return for Disney. And that's what I'm going to start off by doing. So in November of 2013, here's what the numbers look like. My risk-free rate was 2.75%, which was the US T-bond rate. Remind me again why I'm using the US T-bond rate as my risk-free rate? What's the reason? No, that's the answer I got. I'm going to try to repeat the answers. The answer I got was the safest form. It's really not, right? Because you can say this was franc rate is, so it's got nothing to do with safety. It's nothing to do with the AAA rating. It's because I'm doing my analysis in US dollars. So let's be very clear. This is nothing to do with, so the reason, what I didn't want to hear is because Disney is a US company. That's not good enough. If you do your analysis in US dollars, your risk-free rate is the T-bond rate, and you are implicitly assuming that the US Treasury is default-free. If you have issues with that, then clean up the T-bond rate to come up with the risk-free rate. So my risk-free rate was 2.75%. The equity risk premium I got for Disney was 5.76%. And that reflects what? That Disney is a company with 18% of its revenues from outside the US. Remember, we took the weighted average. It reflects where Disney does its business. So it's not that Disney is a US company, but that Disney has these businesses outside. So I got my equity risk premium. And for the moment, I'm going to trust my regression beta. In fact, over the next 20 minutes, I'm going to trash regression betas to the point that you will never use them again. But for the moment, I'm going to stick with the regression beta of 1.25. I'm ready. I've pulled the numbers together. Risk-free rate plus beta times equity risk premium gives me an expected return of 9.95%. If you've taken a finance class, you do this equation ad nauseum to the point that you forget what the number is even telling you. So let's put some intuition behind this number. What does this 9.95% tell me in November of 2013? So let's play a game. Let's assume this is November of 2013 and you are all potential investors in Disney. You're trying to think about whether you should invest in Disney. I'm going to read a couple of statements about the 9.95%, and I'd like you to tell me whether this is a fair way of describing what the 9.95% means to you as a potential investor. So ready? Here's the first statement. 9.95% is the return that you can expect to make in the long term on Disney if the stock is correctly priced and the CAPM is the right model for risk. Read that statement. Look at how many qualifiers I've added, right? Let's start at the top. This is a return you can expect. No guarantees, expect. In the long term, so don't come to me next year and say, where's my 9.95%? If the stock is correctly priced. If it's mispriced, God only knows what it'll make. And the CAPM is, I have 4 qualifiers in one sentence. I'm an incredibly lazy person. I'm not adding 4 qualifiers unless I want to make the statement true. Take that with you. When you look at the first quiz, if you have a true or false question, 4 qualifiers, it's automatically true. Why work so hard? If I wanted me to say something false, it's so much easier. So that is technically the way in which you can think about the 9. And if you lived in an efficient market, this would be it. So if you wanted to make more than 9.95% in an efficient market, what did you need to do? You'd need to invest in a stock with a higher beta, right? Because everything is fairly priced. The only way you make higher returns, and so in an efficient market, this would be it. And I don't like this definition precisely for that reason. Because as you all know, the other class I teach is a valuation class. And what's the essence of a valuation class? If everything were fairly priced, it would be a big waste of time, right? So in valuation, the question you're asking is, what are the good investments to make? What are the stocks which are good buys? So I'm going to give you my second definition, and this is the way I like to think about the 9.95%. You're welcome to join in or stay with the first definition. 9.95% of the return you need to make on Disney in the long term to break even on your investment. You're saying 9.9%. Why can't you just settle for 2.75%, which is the risk-free rate, and say I've broken even? If you wanted to make 2.75%, you would just buy T-bonds, right? Why put yourself through this danger if you're going to make only 2.75%? It's a return you need to make on Disney because you've taken risk, and the essence of risk-taking is you need to be rewarded. It's so if you make exactly 9.95%, wasn't a good investment, it just broke even. Now do you see why that's going to become useful if I'm thinking about investing in Disney? Remember your potential investors. Let's say you go out and do your own research on Disney. You look at the movie business, the theme park business, the cruise line business, and based upon your research, you conclude you can make 12.5% a year. So this is your research telling you can make 12.5%. How much do you need to make? 9.95%. Given your research, which might be wrong, but it's your research, what does that make Disney? A buy or a sell? That's the essence of why we need hurdle rates, even if we don't believe in efficient markets. I've talked to equity research analysts who are actually proud about the fact that they don't get this CAPM stuff. And the way they defend themselves is they say, look, if you believe the CAPM, then you can't pick stocks. That is not true. In fact, without a hurdle rate, how do I decide whether a stock is a good buy or a bad buy? In fact, if you've seen equity research reports, here's the way they usually structure. There's a price today, and there's a target price in 5 years or 3 years. I have never understood what I'm supposed to do with those numbers. So let's say the price today is 50, and they say the price in 5 years is going to be 70. That's good, right? At least it's the right direction. But what's the question you need to answer? Is that good enough? 50 to 70 over the next 5 years works out to about 8%, 9% a year. You're saying that's good, but this is an expected return. And to decide whether the 9% is good enough, you have to look at the risk of the stock. You have to come up with a hurdle rate, just like I did for Disney, and say, this investment is making more or less than what I need to make. That's why it's a break even for it to be a good investment. So if you don't believe in efficient markets, just set that first definition aside. Think of this as the alternate way of what I need to make on an investment for it to break even. Any questions? Now let's flip this around. Let's flip this around. So your potential investors, what did you just tell me? You need to make 9.95% to break even, right? So if I'm the CFO of Disney, you know what this makes it to me? Who are you? You are potential investors in equity or debt? You're potential equity investors. What are you telling me? You need to make 9.95%, not even to be happy, just to break even. This is now my cost of equity. We dress up cost of equity in all this fancy language, but that's exactly what a cost of equity is. It's what you as potential investors in my stock need to make to break even. And what does that tell me? When I go out and make investments as Disney, new movies and new theme parks and new businesses, I better make a return on equity that exceeds 9.95%, because if I don't, I'm not delivering a high enough return to keep you happy. This becomes your hurdle rate for equity collectively. Yes?
I understand that that's the amount that you need to make, but I don't quite understand why it's necessarily the amount that you expect to make, because I understand the beta and the pro.
Expect is, when I say expect, what are you saying is so take the word expect in the most generic sense. Given the risk, this is your expected return. on investments of similar risk. That's basically what that beta 1.25 tells you. So it's expected return on investments with risk exactly like Disney. That's why it becomes your hurdle rate. You're saying, I can go elsewhere, invest in a mutual fund with a beta 1.25 and earn 9.95%. So if I put my money in your stock, I need to make more. That's why it's a hurdle rate. And that's why the word expected can sometimes be a little misleading. It's not what you expect to make on Disney. It's what you think you can make on other investments with exactly the same beta and Disney. And that then becomes what you need to make on Disney as an investment. So the 12.5% is what you actually expect to make, given your research, and you're comparing it to what you can make elsewhere. When we talk about opportunity cost, that's your opportunity cost. It's what you can make on other investments of equivalent risk. Okay? Yes? Okay. Now let me ask you a question. What did I use to get my 9 point? Did everybody get his point? Which is, he's saying the 9.95%, doesn't it reflect some idiosyncratic risk in there? Where does the idiosyncratic risk show up? What did I use? I used a risk-free rate. Nothing, no idiosyncratic risk there, right?
In terms of the Disney management's decision making.
Right. How can I separate the two? I'm investing your money. Disney has no money. I'm just an intermediate. I'm a legal entity. You're an investor. You put your money with me. You tell me. So basically, I've got to think about what you see as risk, not what I see as risk. Disney's managers are just investing other people's money. It's very difficult for managers to let go of this notion that it's their money, and companies have no money. They're investing other people's money, and they have to look at investments through the eyes of those other investments. That's why the marginal investor becomes so critical, is when you look at risk, you cannot bring idiosyncratic risk into the hurdle rate. You can bring it into the expected cash flows and try to deal with the fact that some movies make money. So I'm not preventing you from doing that, but I'm saying the hurdle rate reflects what the marginal investors in your company think about risk, and that risk is only the market component of the risk. Yes? I can see exactly what you're going. So the 9.95% could be 8.5, could be 11.5, because as error, I agree with you entirely. Remember what I said, I'm going to dig a hole for regression betas. I'm going to bury it so deep that you will not be able to find the body. But then I have to give you an alternative, right? Because up till now, that's all we have. And that's all most analysts bring to the game, is a regression beta. I agree with you entirely. It's a problem with regression betas we have to come back and deal with. Okay? So the 9.95% becomes my cost of equity. But let me pause right there. Because for this to be a cost of equity, you have to view this as other people's money that you're investing. I'll tell you a story. About 15 years ago, I was sitting with the CFO of a very large Asian company. And he sits across the table from me and says, he asked me, what's my cost of equity? At the risk of grave personal injury, I said, I think it's about 11.5%. I knew what business he was in. I knew what. He said, no, it's not. I said, why the hell do you ask me if you already know what it is? At that stage, I was too deep in, I couldn't get out. So I said, what do you think it is? He said, it's about 1%. What do you think he was calling his cost of equity? How did he come up with a 1% cost of equity? That seems absurdly low. No, it was his cost of borrowing money was 5%. He was actually in a risky country. What he was paying in dividends, he said, that's the only cost I see as a company is the dividend. And if you define dividends over price, what's the cost of equity for Google then? It pays no dividends, equity is free. That's so nice. A project with a 1%. So now let's play devil's advocate. Let's say I'm the CFO. I say my cost of equity is my dividend yield. Convince me why it's not my dividend yield. Where does the extra 10.5% come from? I told you my estimate of the cost of equity for him was 11.5% risk-free rate. When I come up with 11.5% cost of equity, what's the extra 10.5% that I'm putting into my cost of equity? If only 1% is dividend, what's the extra 10.5%? It's price appreciation. You don't buy stock just to collect a 1% dividend. You'd be crazy to do it. Because if you wanted just a 1%, you could buy a very safe bond and get that 1%. So I told him the extra 10.5% is for price appreciation. And then he asked me a question that floored me. He says, what if I don't deliver that price appreciation? You see where he was going? If you borrow money at 5%, you don't pay interest, what happens to you? You go, forget, if you don't pay interest on debt, it's not that your stock price goes down, you go bankrupt. That if you don't pay, if you don't deliver price appreciation, you don't go bankrupt. You can't sue in court saying, where's my 10.5% price appreciation? So what if I don't deliver it? So what's the answer to that? What if I consistently underperform that 11.5%? Your price will go down. That's what I told him. Your stock price will collapse. He said, I don't care. We don't plan to raise money. We're a mature company. We don't plan to go to the market. What do I care what happens to stock price? So hit me with the final point. What will happen to me as a CFO if my stock price keeps going down and down and down? I said, you're going to get fired. He started laughing. He said, do you see the last name on my nameplate? I said, yes. You see the last name on the company? I said, yes. You see their match? And you know we control all the voting shares. You see where he was going, right? He said, we control the company. There's nothing you can do to us. And now do you see why we spent almost 3 sessions on corporate governance? Because if you view this as your company and stockholders have zero power over managers, guess what? Increasingly, you're going to think about the equity as free capital. And then what are you going to do? You're going to take projects that make 1, 1.5%, 2% and be dancing on your desk saying, hey, I beat my cost of equity. That's what Japanese companies did in the late 80s. And they're still digging themselves out of the investments they made because they thought capital was free. The weaker corporate governance gets, the more cavalier managers will be about using equity capital, because what the heck are you going to do to them? If they're growing companies, they worry about having to raise more stock, but if they're not, they're going to treat you like dirt, and there's nothing you can do about it. So when you assess the corporate governance of your company, that's one of the reasons you're assessing it, is to make a judgment on whether this will in fact fly as your cost of equity. So when you get a chance and you get your regression beta page, and I'm assuming that some of you have it, but most of you don't, I'd like you to take that page apart. In fact, I put that webcast up last Friday where just put the regression beta page to one side, and while you watch the webcast, you can actually do the numbers. And here are the numbers I'd like you to come up with for your company. Tell me whether your stock was a good investment over the 2 years of your regression. Why 2 years? Because the Bloomberg default beta page is 2 years, and unless you change it, it's a 2-year regression. So look at the Jensen's alpha. So basically compare the intercept with the risk-free rate times 1 minus beta. It's good exercise for your quiz anyway. So don't think of it this as separate and you do it after the quiz. Do it before the quiz. Then look at the raw beta for your stock. It's a regression beta. And then look at the standard error in the beta. It'll give you the range on the beta. Then look at the R squared. What does the R squared tell you again? The proportion of risk in your stock that came from the market. Get a judgment of where the risk in your stock comes from. And then bring it all together at the very end by doing exactly what I did for Disney. But that's going to take a little work on your part because you have to choose the currency at this stage, which is a good choice to make anyway. Get the risk-free rate in that currency. And for the equity risk premium, you got to look at the geographical distribution of revenues for your. So it's actually a great way to get caught up on the project. If you can get the expected return at this stage, you're caught up on the project as of now. And that's a good place to be going into quiz 1. So try pulling all those numbers and doing it for your own company, because until you do it, you might get it intellectually, but until you start plugging numbers in, it's not going to stick as a way of thinking about hurdle rates. Any questions? Now I'm going to set up a process which is going to launch us into a different way of thinking about betas. So let's say you get this process. Risk-free rate plus beta times risk premium is the cost of equity. You decide this is enough corporate finance, I can do it. So you set up a consulting firm. It's easy, you know. And I'm your first client. I'm the CFO of a very risky software company. So I come to you for some advice. I want a cost of equity for my company. So that's easy. You start with the risk-free rate. Let's say it's 3%. Then you look at the beta for my company. It's 3, so I'm a very risky company. And let's say the equity risk premium is about 5.5 or 6%. And you pull all those numbers together, and based on your assessments, you come up with a cost of equity of 20% for me. So you come back and tell me your cost of equity is 20%. First question is that, if I'm a CFO of a company, you give me a cost of equity of 20% in US dollars. That's a pretty high number, right? Am I feeling good about this or bad about this when I see that 20%? Do I want this number to be a high number or a low number? I want this to be a low number. So I said, that's a really high hurdle rate. Why is it so high? And you tell me. What's the culprit here? What's causing my cost of equity to be so high? It's my beta. And you give me a very, very constructive story of how risky I am. So then I ask you a question, and let's see if you can, there are three answers you can give to this question, but let's see if you can get maybe 2 out of the 3. Say, is there something I can do as a company to bring my beta down? Because I can see if I can bring the beta from 3 to 1.5 or 1.2 or 1, my cost of equity. So what are the things I can do as a company to reduce my beta? Because if you can start answering these questions, we're going to be getting away from regression betas and thinking about what the fundamentals are that drive betas. Anybody want to try? What can you do?
Maybe you can try to get more recurring revenues.
One is you can try to change your business model to make, because right now your beta is high because your revenues are very, very unstable, right? So maybe there's something you can do to change the way you do business to make your betas or your revenue. You say, what the heck can I do? I don't know whether any of you are subscribers to Office 365 or to Adobe. I mean, increasingly what software companies are doing, in the old days, the way they used to make revenues was they used to sell you software and then make more revenues when they sold you updates. So their revenues would spike and drop. And what's the advantage of an Office 365 to Microsoft? It's an annual subscription. So it's like a Netflix subscription, perhaps not as important, but it's there. And there are 2 advantages of getting an annual subscription to replace an update model. First, it makes your revenues more stable, right? Second, we know that once people subscribe to something, there's a behavioral finding, which is you often forget to unsubscribe from it. Right? There are things you subscribe to, you go back and look at it, what the hell was that? 17 years ago, I started subscribing to it. I completely forgot about it. It still shows up every year in your credit card bill. So that's the first thing. I can make my business more stable, and by doing so, maybe I can lower my beta. So that's the first. Any others? Yes? If I have debt, reduce it. Tell me why debt makes my beta high.
Because the beta is the lever, and beta so it's 2 components of your capital.
Give me a more intuitive reason. I get it. I see. Because let's say I'm a CFO. I have no idea what levered betas or unlevered betas are. Tell me how having debt makes my equity riskier.
So it increases your financial risk or your risk of default.
And also, what do I have to pay every year when I borrow money? A fixed interest expenses. So in good times, my equity earnings are much higher. In bad, so what it does is makes my earnings more unstable, more volatile, no matter what business I'm in. So if I have debt, I should pay it down. So what kind of business are you and how much debt do you have? Anything else? Build on that same thing. What was it that made debt make my equity riskier? I had interest expenses which were a fixed cost, right? If I can somehow reduce my fixed costs as a company by doing what does outsourcing do? Instead of you paying for 50 copiers that you have to maintain every year, you outsource your copying. You might actually pay more, but it also means that you don't have that fixed cost you used to have. Or when you negotiate with the unions, you say, look, we'll pay you 10% more than you've asked for. In return, we'd like to be able to cut wages if our revenues drop by 15%. More flexible wage contracts. What kind of business are you and how much have you borrowed? What are your fixed costs? We're going to come back and nail these 3 back down because those are the 3 variables that will determine your beta. I'm glad nobody said, why don't you play with the regression parameters? Because you can, right? You can sit there and say 5 years, 2 years, weekly, daily. 3 can become 2, 1 point. And the only reason that's cheating is that's like my getting, I mean, I used to have a treadmill until it broke 3 years ago, so now I have to run outside. But for the longest time, my dream was I can run only like 35 minutes is my limit for exercise, and I can do whatever I want for the rest of the day. So first thing in the morning, I get up on the treadmill, and my dream always was to burn 1,000 calories in 35 minutes. How difficult that is. I tried the treadmill at maximum speed. I'm just holding on to the side like crazy. 35 minutes later, I look, it's only 620 calories. So until one day, I discovered the secret, which is when you get on the treadmill, what does it ask you? How much do you weigh? Try entering 500 pounds. It's amazing how the calories burn off. You can walk 1,000 calories. You're moving, amazing. Okay? The problem, though, is at the end of the 35 minutes, it looks like I burnt off 1,200 calories on the display, but the reality is I still burnt off exactly what I did the previous day. So that's why I'm glad nobody said, let's cheat with the regression beta, because that's really cheating. But hold on to those thoughts, because we'll come back to those three. Now let me ask you a follow-up question. So there are things I can do to make my beta lower. If I make my beta lower, what happens? My cost of equity comes down. This is good, right? So every company should just go out and do this. Focus on lowering betas. True or not true? For instance, let's take the debt. You pay down the debt, your cost of equity will always go down. But you've now taken out a way of financing that might actually be cheaper than using equity. You can reduce your fixed costs, but by outsourcing, you might lose control of quality. You might actually sell fewer items. There's always a trade-off in finance. Nothing is a slam dunk. In fact, my advice to companies with really high cost of equity is just live with it. Your job is to not play with the cost of equity. It's to go out and deliver high returns on equity in whatever business you're in. Do you think Facebook had a pretty high cost of equity over its last 5 years? Absolutely. Do we still celebrate it as a successful company? Sure. Why? It's made a 35% return on its projects. Does Con Ed have a really low cost of equity? Probably. But it has an even lower return on equity. You're saying, why can't I have a really low cost of equity and a really high return on equity? That's when you bring the danger plus opportunity definition to that person. Say, you can't have one without the other. So don't get too focused on your cost of equity being a high or low number. There's nothing there that you're going to draw conclusions on. It's just a hurdle rate you have to beat. Yep.
Company sees that they have a high cost of equity. Is there value in them realizing at that moment, okay, let's look at these three elements and just assess we're being efficient there?
Absolutely. And the question was, if you have a really high cost of equity, should you look at what's making your cost of equity high? Absolutely. And that's why I want to open this process up. Because as long as we think of cost of equity as coming from regressions, we feel helpless. There's nothing you can do. Now I've at least given you the levers, and you can start thinking about, does it make sense for you to change your business model, to reduce your fixed costs, to pay down debt? And maybe the answer is yes. But you need to be aware of what's driving your beta high. So let's complete the regression beta page before we come back to these variables. So what I'm going to do is I'm going to take my other companies and show you what my regression betas look like, and then kind of complete the burying of regression betas. So I decided to look for the regression beta for Tata Motors. I went to Bloomberg, looked at the beta page. It ran the regression against the Sensex. Why? Because Bloomberg is very parochial about the way it estimates betas. You ask for a beta of an Indian company, it runs it against the Sensex. The beta that it came back with was 1.83. That was the regression beta, the raw beta. Remember, the adjusted beta tells you nothing. It just moves the raw beta towards 1. The standard error on that beta was 0.16. I'm sorry, 0.16, which means the range in my beta is 1.67 to 1.99 with 67% confidence, and it's even wider if I have 95% confidence. The R squared was 69%. So if I trust this regression, 69% of the risk in Tata Motors comes from the market, 31% from the company. The Jensen's alpha for Tata Motors on an annualized basis was 35.42%. What does that tell you again? You wished you'd bought Tata Motors in 2008. Remember that. It's not telling you anything about future investments. This is an incredibly successful 5-year period. You know what made it successful? Tata Motors in India actually had a terrible 5 years. Its cheapest car in the world turned out to be really cheap and nobody wanted it. It actually had lots of trouble with its Indian operations. But what did it get outside India? It bought Jaguar Land Rover. It bought it at a bargain. It's not that it bought that company, but it bought it at a bargain. It paid off big time. That's a 35.42% Jensen's alpha. In fact, that's one thing you should do. Once you get the Jensen's alpha for your stock, ask, Now, why is it so bad or why is it so good? And start looking for either something happening in the company or the sector, because it could be either, that's causing your number to be what it is. And finally, to the expected return, I decided to do this in rupees. Remember, I'm not forced to. I could have done it in US dollars. I could have done it in Swiss francs if I wanted to. And the risk-free rate I used was 6.57%. I'm sure none of you remember that number. But that actually came from looking at the Indian government bond rate of 8.82% and subtracting out the default spread for India, 6.57%. The beta that I've used is the 1.83. The equity risk premium for Tata Motors is not the equity risk premium for India, but the weighted average. Remember, China is the second largest market, so basically it's a weighted average. My rupee cost of equity for Tata Motors is 19.73%. Two things to keep in mind. It's high partly because it's in rupees, not in US dollars, higher inflation rate. And it's high because my regression beta is 1.83, which means that if I trust that beta, it's telling me Tata Motors is 1.83 times more risky than the typical company. So that's my Tata Motors beta, and you can already see that it rests very heavily on trusting that regression beta. For Vale, I actually estimated 2 betas. Why 2 betas? Because first I took Vale, the local listing, and regressed it against the Bovespa, and I got a beta of 0.89. So that's against the local index. But Vale also has an ADR, which is the listing in the US, which is denominated in dollars, and that regression gave me a beta of 1.37. Remember I said I'm going to dig a hole for regression betas? Let's start digging. You want to get the beta for a company, especially if it's got multiple listings, you can get 6 different betas for your company. Which one are you going to use? Whichever one you wanted to fit your story. That's the reality we face. Is not only are regression betas extremely noisy, but they can be very easily manipulated. I've seen equity research analysts play with the Bloomberg beta page and they get exactly the beta they want, which kind of defeats the whole purpose of estimating betas. But I just want you to be aware of how different the numbers can be for the same company with different indices driving the beta. So if you get a chance on a Bloomberg terminal, if nobody's waiting behind you, once you get the beta page for your company, you can actually change the index on Bloomberg. So it says SPX, let's say it's a US company, you can change it to the MSCI Global. You can try the NASDAQ, the NYSE, the Dow. Just start playing. You'll be amazed at how much your raw beta shifts as you go from index to index to index to index. And you get you realize how much power you have to decide the outcome if you can play with those numbers. And finally, for Deutsche and Baidu, I decided to see how sensitive the beta estimate was for different indices. So for Deutsche, I tried the DAX first, the German index, because it was the default. And then I replaced it with the FTSE Euro 100, which is the 100 largest market cap stocks across Europe, arguing that today Deutsche is not held just by German investors, but it's increasingly held by European. In fact, I should have probably added a third column, because it's probably held by global investors. I'd have a DAX, a Euro 100, and an MSCI. In fact, this week's challenge, that's exactly what I did with Volkswagen, is I ran 4 different betas. And you're going to see how different the numbers are depending on the index I use. With Baidu, I ran it against the S&P 500 and the NASDAQ. Why the NASDAQ? Because Baidu is actually listed on the NASDAQ. And so let's see how different it is if I run it against the NASDAQ. Again, the beta is very close, 1.63 and 1.65, but the other coefficients reflect the fact that I'm running it against different indices. So here's what I suggest you do. Before you go to the Bloomberg, decide what index you're going to use for your regression. Right? Because after you get there, if you try to decide, you'll be planning, that doesn't look right, that looks too high, that looks too low. You're going to be playing games, make a decision, but then check to see how the beta changes, because if nothing else, it will make you more aware of how choices drive these betas. So here's what we're going to do to kind of close the process. I don't like regression betas. I don't like regression betas for 3 reasons. One is they're backward looking. Why backward looking? Because run a regression, I read returns from the last 2 years, last 3 years, last 5 years. Second, they're noisy. Noisy in what sense? They have that big standard error. Third, they can be manipulated. And I can't imagine running an entire corporate financial analysis or evaluation based on such a shoddy number. So what I'd like to do is give you a way of thinking about betas that doesn't depend on regressions. So here's what I'd like to do. I'd like to list a bunch of companies and their betas, and with each one, I'm going to give you the beta for the company, and I'm going to tell you a story about why I think it has the beta that it does. And along the way, maybe we can start gathering together the variables that drive betas, which we've already identified in that software CFO example. So let's start at the top. Bulgari, really high beta. What does Bulgari sell? Stuff that nobody needs at prices nobody can afford, that you're fine without. It's a supremely discretionary product. If you say, look, I cannot live without a Bulgari, something wrong with you, right? So basically, the more discretionary your product or service is, the higher your beta is going to be, because you're going to be much more affected by swings in the economy. High beta because very discretionary product. We'll come back to that point. Okay? Quest Communications, I don't even think it's around anymore. But if you look at telecom companies, they tend to have high betas. Not that discretionary product or service, right? The business is not that risky, so what makes telecom companies have high betas? In fact, we've identified two of those variables already. One is they tend to borrow a lot of money. We'll come back and talk about the absurdity of doing that. The second is they have lots of fixed costs, right? You have to put up those big cell towers, whether one person uses them or 100. So lots of fixed costs, lots of debt. Actually, that doesn't make any sense. If you're in a business with lots of fixed costs, Corporate Finance 101 says don't go out and borrow money because you already have a lot of fixed costs. So why do you think telecom companies borrow as much as they do? You know what their answer is? Because AT&T did it 100 years ago. I'm not kidding. AT&T did borrow a lot of money when it was Ma Bell and they were building. But the reason they were able to borrow that immense amount of money was why? Because once they borrowed the money and built the phone system, they were selling into a monopoly. So they could charge cost plus. So it made complete sense for the phone companies of 100 years ago to borrow money and build infrastructure. But if you're Verizon and you're borrowing money and building infrastructure, you're not building it into a monopoly anymore. One of the things I'm going to argue in this class is a lot of what we see in corporate finance is driven by inertia. Companies do what other companies used to do 20 years. They've forgotten the fact that the business has changed. If I was starting a telecom company from scratch today, I would not borrow money. It makes no sense. These are more technology companies than old-time phone companies. But for whatever reason, they borrow a lot of money and have a lot of fixed costs. There's Quest. Microsoft kind of moved up and down depending on the year. When I first started tracking Microsoft in 1986, it's right after their IPO, the beta was 3. Very risky, young company. Over time, the beta tended to drift down. In the last couple of years, it's bounced back up again. But if you think about why it's drifted down, the company got bigger. That by itself is neither here nor there. Its customer base got more diversified with Office and Windows and other stuff. It geographically started spreading its revenues. And as companies get bigger and more diversified, their betas tend to inch down towards 1. This is actually the tendency that Bloomberg draws on to adjust betas towards 1. So Microsoft, if you look over time, so you see the effect of companies getting larger, getting bigger cash balances, getting more diversified. Look at GE. What business is GE in? Actually, the question I should ask is, what businesses is GE not in? Right? It's in, what, 26 different businesses. It's trying to get out of them desperately now, some of them at least. But what should happen? And this is a classic conglomerate, right? What should happen to the beta of a company as it starts spreading across multiple businesses? The beta should move towards 1. The only reason GE's beta stays above 1 almost consistently is the biggest single piece of GE is GE Capital. You think, so what? GE Capital is really a bank. And what do banks have on the balance sheet that's going to affect your beta? They have a lot of debt. GE Capital alone carries $150 billion in debt. That's like a ballast on your beta, pushing your beta up. ExxonMobil, beta of 0.70. You think it's an oil company. Oil companies are risky. When you say oil companies are risky, what's a big risk you tend to think about? Oil price risk. And for a long time, maybe not in the last couple of years, oil price risk actually cut in the opposite direction for much of the rest of the economy. What do I mean by that? Oil prices go up. ExxonMobil was happy, but airlines were affected badly. So historically, if your biggest risk is coming from commodity prices, and the rest of the economy is actually being cut in the opposite direction, your beta is not just going to be low, it could even be negative. In fact, it doesn't happen with oil, because oil, there is that factor that's going to kick in. But see a Harmony gold mining negative beta? That's actually mind-boggling. Because when you have a negative beta, what do we use this for? For a hurdle rate, right? Risk-free rate plus beta times equity risk premium. When you have a negative beta, what's your expected return going to be on a stock with a negative beta? It's going to be lower than the risk-free rate. You're saying, why would I settle for that? When you buy a negative beta stock, you know what you're buying? You're buying insurance. You're buying insurance against some big macroeconomic risk. Historically, the only business that I know of that's been able to have a negative beta is gold. Gold mining stocks. And what's the macro variable you're buying insurance against when you buy gold? Historically, what has it protected you against? Inflation. Historically, gold has been a hedge against inflation. So if you have $9 million invested in financial assets and you're worrying about inflation going up, adding a little gold will actually make your portfolio less risky. You're buying insurance against inflation. The key word is buying. So how do I make you pay? You have to settle for less than the risk-free rate. It makes complete sense if you think about it that way, as insurance that you're buying. You know when it doesn't make sense? If you take all your money and buy Harmony Gold Mining. What's going to happen? You're going to offer return over time. You're going to whine about it all the time. Why, I took all this risk and nothing good is happening to me. Nothing good should happen to you. And that's my reaction when I see, you've heard of gold bugs. These are the people who think you should have all your money in gold all the time. I get at least a half a dozen emails from them every day. Pull your money out of stocks, send it to gold. I just keep the emails coming because I just want to see the creative reasons they keep coming up with for why this time is different. It doesn't make any sense if you put all your money in gold mining stocks, but if you add gold mining stocks to an otherwise diversified portfolio, you will settle for less than the expected return. And then you have Altria, beta 0.60. Why is the beta so low? What's the opposite of non-discretionary? The complete other, the opposite of discretionary. Bulgari you're perfectly well living without, but if you want a really, really low beta, what should you do with your product or service? Make it an addiction. And before you jump all over Philip Morris, and that's awful, if Morgan Stanley could addict you to structured products, would they do it in a second? Of course. If the Gap could addict you to khakis, they would do it, right? If they could just slip a drug and say, if you never wear khakis, you will never dance again. Right?
What is the data of Coca-Cola?
That's a good question. I'm going to throw it back at you because after I've set up the variables, I'm going to come back and ask you that question. Because by the end of these next 20 minutes, you will have an intuitive way of thinking about what kinds of companies should have high betas and low betas. So ready? Let's get started. The first factor driving your beta is what kind of business you're in. Other things remaining equal. Remember, beta measures how you move with the market risk. So if you're a cyclical company, you should have a higher beta than if you're a non-cyclical company. At least that used to be the old smokestack definition of the distinction we drew in businesses. What are some good cyclical businesses? Historically, what have been? First, what's a cyclical business? It moves with the economy, right? When the economy is doing well, you do really well. When the economy is doing badly, you do really badly. Historically, housing and steel were viewed as cyclical businesses. Food processing was non-cyclical. Until about 20 years ago, that was the distinction I used to draw. Cyclical businesses have high betas, non-cyclical have low betas. Let me ask you a question. As we move away from smokestack economies, this distinction gets tougher to make. Is Facebook a cyclical company? See how much more difficult it is when you move away from it? Some of you might say yes. Some of you might say, I can't live without Facebook. If it gets really bad, I'm going to be posting like crazy on Facebook. Maybe that's all I'll be doing is, checking out of my regular life, going online for the 3 years of the recession, then I'll come back. Much more difficult distinction to make. So I'm going to give you the second way of thinking about why some companies have high betas and others have low betas. The more discretionary your product or service as a company, more discretionary customers, the higher your beta will be as a company. Let me put some flesh on that. When I say discretionary, I mean your customers can live without your product. They can delay buying it. They can defer buying it. Then you'll have a higher beta than if they cannot do that. I'll give you two simple ways of kind of nailing this concept down. The first is to put yourself at the kitchen table of the average family as they're making a list of what they're going to buy this month with their income. You ready? We're sitting at the kitchen table. The family's going to start listing items out in order of priority. What's on top of the list? Food, right? Groceries. Then you have rent, diapers. It's pretty nasty when you have kids wandering around, not toilet trained. And then you keep going down the list and you start adding items you will buy if you have the income. Take a look at that list. The further towards the top of that list your product or service is, the lower your beta. The further towards the bottom of the list your product or service is, the higher your beta. So you ready? I'm going to throw some company names at you. Based on that listing, tell me whether you'd expect them to have a high beta or a low beta. Safeway. What does Safeway do? We're saying Whole Foods. Higher than Safeway at least, right? Why? Because you're willing to pay 4 times the price for eggplant because you feel rich. If you don't, you're saying, I'm going to die anyway. Who cares? Organic, inorganic. I'm going to go into the ground. So let me just eat whatever eggplant I can get. So within the grocery business, Safeway should have a much lower beta than Whole Foods. What about Coca-Cola? Ask yourself, how desperate do I have to get to go down the generic cola aisle in the grocery store? And the answer is really, really, really desperate. Low price plus brand name, keep it at a low beta. New York Times. There are 2 ways the New York Times makes money, right? One is subscription revenues, which are remarkably stable. Why? Because people hate to send the wrong signal to their neighbors. So you've lost your job, you really can't afford the Times, but you're afraid to cancel it because people will notice. So what do? It gets lands on your driveway day after day. You just pick it up, throw in the recycling every day. But you're willing to pay the $2 a day just to preserve the illusion that you read the Times every day. So subscription revenues are pretty stable, but they're about 1/3 of the revenues to the New York Times. The other 2/3 come from advertising, which is, in fact, you can tell how the economy is doing by just how much effort you have to exert to pick up the New York Times on a Sunday. If you lean down, you can't pick it up. It's so fat. The economy is doing really well. The magazine, you've seen these glossy fashion magazines which go 150 pages. You say, who the hell even looks through this stuff? That's a sign of a good economy. So advertising is much more discretionary. That makes the New York Times have a higher beta. Tiffany's. There's nothing, again, in that store any of us has ever needed. High beta. So the first thing to do is think about your product or service. Let's move to the second way you can think about this. So I think this weekend is supposed to be nice. I don't know yet, so no guarantees. I know it's a weekend before your quiz you'll be preparing. Take a break. You'll need about an hour and a half for this, maybe 2. So go uptown on the end of the hour. Get off at 60th and 5th. It stops there, I promise. Get out of the subway, start walking downtown on 5th Avenue. Ready? We're going to go for a virtual walk down 5th Avenue. And here's what I'd like you to do. As you walk down 5th Avenue, I'd like you to stop in front of every business you pass and very loudly ask the question, if that business were traded, what kind of beta would I expect to have? You're saying, why loudly? People will think you're crazy. And that's a good thing. Tourists will cross the street to avoid you. Get the entire sidewalk for you. So you ready? Let's go for a virtual walk. 60th and 5th, we're walking downtown. What's the first business I pass? It's to my left. Apple. Let's keep going because nothing in that store is discretionary as far as I'm concerned. That's just a personal problem. But right next to Apple used to be another store. FAO Schwartz. I heard Bergdorf, don't jump blocks on me yet. Right? We're still at 60th and 5th. These two. FAO Schwartz, high beta, low beta? Depends on who's making the list. I still remember when I brought my my oldest son, he's now 26, when he was 8, I brought him into the city. Euphemistically, we'd call it coming in with Dad to work. We'd come in, we'd go to a baseball card store. Then we'd have a snack, and then a toy store, another snack, a baseball card store, a third snack. And after about the fourth store and the fourth snack, he said, Dad, I want to go home. See, I thought you wanted to come into work with me, Ryan. And he said, I don't care about your work, Dad. So the truth would come out sooner or later. But it was around his 8th birthday. I bring him in. I take him into FAO Schwartz. And there's a Ferrari on sale for $8,000. See, that's a really cheap Ferrari. It's like one of those. You see the movie Big, right? Tom Hanks. It's a Ferrari for an 8-year-old with everything. I still remember what my son said. He said, Dad, if I don't get that, I will die. I said, I don't think so, Ryan. Let's walk around. If you're drooping on the verge of death, I'll bring you back. 18 years later, he seems to be okay. A lot more discretionary than he made it out to be. So high beta, right? So let's cross 59th. We're now in what I call the French-Italian section of town. Gucci, Ferragamo, high beta, high beta, high beta, high beta. No. Keep going. I've heard you can get charged if you walk too slowly. So walk by all those windows. You get to St. Pat's on your left. Don't ask high beta, low beta. Lightning might strike you down. Some things you don't mess with. And then you get past Rockefeller Center. The betas start to fade a little bit. You notice a lot of Dwayne Reeds that pop up trying to get you? You zigzag your way down to 42nd. You get past the New York Public Library. I remember when you got past the New York Public Library, betas hit rock bottom. It's a little better than it used to be, but I remember a time when you'd walk by it, and every store had brown paper in the window, a shady-looking character in the doorway saying, come on in, cheap, cheap. Cheap what? Just come on in. You'd see tourists going in and not coming out. I don't know what kind of risk that is, diversifiable, non-diversifiable. But if you made it through that gauntlet all the way down to 34th and 5th, there was a guy who sells umbrellas. He's still there, I think, only when it rains. I don't know where he comes from. One of these days I'm going to hang out there, hide somewhere, watch. I think he pops out of the ground. Crappy little piece of it, it'll fall apart in about 6 blocks. But if you have a laptop on your back and 6 blocks to the nearest subway stop, you're willing to pay that $10 for a crappy umbrella. If that guy could figure out a way to incorporate and trade. Umbrellas when it rains on 34th Street, really low beta. You tell me what you do, I can guess your beta. So that's the first stop to make, is ask yourself, is this product or service discretionary or non-discretionary? And the more discretionary it becomes, the higher the beta will be for your company. So let's try this out. Let's think about a business, telecom services. Let's face it, in much of the developed world, phone service is non-discretionary. In fact, I'll wager that if I asked you, do you need to eat this month or do you need your cell phone, you'll have to think a lot. Can I survive 30 days without eating? No. So the reality is, in much of the developed world, if you looked at telecom companies, they're non-discretionary. In much of the emerging markets, it's, while people have more cell phones, the kind of service they get is very minimal. But if things go well and the economy grows, you're going to see telecom service kind of grow. So in emerging markets, it's a lot more discretionary than in developed markets. So take that as a given. If you believe that statement, and I gave you the betas for telecom companies in developed markets and the betas for telecom companies in emerging markets, which one should have the higher betas? Emerging market telecom companies should have higher betas than developed market telecom companies. So you're saying, for the moment, you might say, who cares? You're going to see that this is going to matter when we start thinking about a different way of estimating betas. So think discretionary, non-discretionary, differences geographically, and you have the foundations for thinking about betas. So that's stop one, is what kind of business are you in? Let's take the second stop. Tell me something about your cost structure. The greater the proportion of your costs that are fixed costs as a company, the higher your beta will be as a company. Think through the mechanics of why. If you have a lot of fixed costs, let's say you sell nothing in a year, you're going to lose a huge amount of money because the fixed cost is still there. You sell a lot, you're going to make a huge amount of money because the costs are kind of stuck. What fixed costs do is they make your mood swings into manic depressive mood swings. Small mood swings will become big. They basically magnify your mood swings. So if you're in a sector with a lot of fixed costs, I would expect you to have a higher beta than if you're in a sector with low fixed costs. Let's take an example. Let's take the airlines. Think about the cost structure for an airline. What's the biggest single expense? Leasing the aircraft. Fixed cost or variable cost? Fixed cost. You can't go to GECAB and say, our planes are only half full, can I pay you half the lease? It doesn't work that way. Fixed cost. Second biggest cost? Fuel. Fixed cost or variable cost? Well, it's variable until you put the schedule down, and then you have a bit of a problem, right? Because you put the schedule down, then people start getting on. There are only 5 people on the plane. I come out as a pilot and say, 1, 2, 3, 4, 5. And then I yell out of the window, only 5 people on, let's fill it halfway. Let's see how far we get. Because once I decide to go New York to LA, there's a little variance I get based on load, but fuel costs become fixed costs. If you unionize airline, the number of stewardesses is fixed, the number of pilots is fixed. Fixed cost. Now do you now you see why airlines never have a normal year, right? They're either going bankrupt or they're making billions. That's exactly the way it is. You never have a normal year for an airline because that's exactly what high fixed costs do to you. And just to show you that even within a business like the airlines, you can have outliers. You know which one I'm going to talk about, right? The most written about company in the history of cases, the Harvard Business School, is Southwest. I'm not going to beat a dead horse by talking about strategic things. I have no idea what strategic things they do. But I'm going to focus just on this cost structure issue with Southwest. It leases aircraft like every other airline. But until about 5 years ago, if you took a Southwest flight, what kind of aircraft were you on? Every single aircraft Southwest had was a Boeing 737. Why? Because every single aircraft is unique enough that it needs its own maintenance crew. And what Southwest decided early on was, we're not going to keep 3 maintenance crews. That's bigger fixed costs. We're going to have one type of aircraft, 737. Fuel costs. I do take Southwest sometimes. I hope they don't economize on fuel costs. But they're one of 2 airlines that consistently hedges fuel costs. The other is Singapore Air. You know what I mean by consistently? They just hedge, no matter what the oil price is. As opposed to most of the airlines which start hedging when? When oil prices are 120. And when do they stop hedging? When they get to be 25. They start hedging it. In fact, the perfect contraindicator to oil prices is look at what airlines are doing. If they've stopped hedging, then oil prices are going up. If they've started hedging, they're going to go down. Either hedge or don't hedge. Don't play this little game of trying to forecast oil prices because you're not very good at it. Southwest says, we're not good at it. We just hedge oil prices. Third, if you look at it, the Southwest is a unionized airline. People are surprised when I say that, but they have the most flexible workforce of any of the airlines. It's the only airline I've flown where a stewardess has checked me on. Has it ever happened to you on United? I mean, you can sit there with the podium until it falls apart, surrounded by 30 stewardesses, all checking their job description, saying, I've never done that before. And here's the final cost. I remember the first time I took Southwest was about 15 years ago. I buy the ticket, New York to LA, maybe 12 years ago. I just forget all about it. Then the day for the flight, and the day before the flight, I look up which airport is it out of, JFK, LaGuardia, Newark, hoping it would be Newark. And I look at the ticket, and it's none of the 3. You know where Southwest used to fly out of from the New York area? Islip. I didn't even know where Islip was. If I hate to insult you, if you grew up in Islip, I'm sure it's a really nice town. I'd look it up on the map. It's some small town in Long Island. So what the heck are they doing? Can you imagine getting into a cab and say, take me to Islip? See what happens? No. I get there. I fly out of the New York area. I land in LA expecting to land in LAX. I come out of my plane right out of the gate, and there's this huge statue of John Wayne. The airport said, this isn't LAX. And I'd landed in Santa Ana Airport. And this was a pattern that Southwest adopted across the country, right? They didn't fly into O'Hare, they flew into Midway. It's a pattern that European budget airlines have taken to heart. I remember taking a European budget airline once. I will never do this again. I landed in the vicinity of Paris. I was in France somewhere. That's their definition of Paris. About 120 miles from Paris, So how do I get there? Just walk. But why does Southwest do this? Have any of you flown United out of Terminal C in New York? You have to do this at least once in your life, just to get the experience. There are like 200 gates there. So they do things like fly you into gate 3, connect you in gate 123, just to see if you make it. I'm sure there's a guy upstairs watching you on a camera saying, he'll never make it, let's switch the signs on him. They're playing games with you while... But how do you think they keep all 200 gates? They pay Newark Airport for the gates, just like British Airways pays. I mean, for the one reason Virgin Atlantic could not fly into Heathrow for the longest time is British Airways owned enough gates that they could shut Virgin Atlantic up. And United has to pay for those gates, whether one plane leaves out of them or 100 planes leave out of them. For the longest time, Southwest said, we're not doing that. It's a fixed cost. What did they gain by that? Right after 9/11, there was a point in time where the market cap of Southwest was greater than all of the other airlines put together. That's what low fixed costs do for you. So why doesn't every airline do this? Has Southwest paid a price for this strategy? I'm sure there are people who don't fly Southwest because they don't want to fly out of Iceland. So they were willing to accept that. They said, we'll accept less revenues in return for having a more flexible cost structure. That's what I meant about trade-offs. Companies have to make that judgment as to whether they want a more rigid cost structure and go after... There was a point in time, right, I think in the late 90s, where I used to take British Airways flights to London, and half the plane was business class. Half the plane. You think, what's that got to do with betas? That's $6,000. I mean, New York, London is perhaps the most overpriced segment in the world. Why? Because investment bankers fly back and forth, and they pay $6,000, and the rest are saying, "What the heck are you doing? It's other people's money." So back and forth. Let's charge it to our. But the problem with that is you adopt a business class strategy like that, you're making your beta higher because you're making your entire business more discretionary. So one stop you can make is ask that question about your company. Does my company have a lot of fixed costs or variable costs? And here you're going to run into a bit of a problem. Because accountants don't break costs down into fixed and variable. You take any financial statement, there's revenues, there's cost of goods sold, SG&A, depreciation. You can try to guess what's fixed, what's variable. It's tough to tell. So I'm going to give you a trick that might or might not work for you. What do we say about fixed costs? When you have lots of fixed costs, you'll make lots of money in good times and lose lots of money in bad times. Small changes in revenues will translate into big changes in operating profit. So here's what I do. I take the percentage change in your operating income each year and divide by the percentage change in revenues every year. And if I get a very high number, I'm going to argue that you have lots of fixed costs. Of course, you can't do this with any one year because strange things can happen. With Disney, here's what I did. I went back all the way to 87. I computed the percentage change in revenues every year and the percentage change in operating income every year. Across the entire period, 87 through 2000, my revenues went up about 11.79%. My operating income increased by 11.91%. You divide 11.91 by 11.79, I get a 1.01 as my measure of operating leverage. I'll come back and talk about how I'm going to read that, but if I take the entire period, it's almost 1-to-1. I then look post-96. What happened in 96? That's the year Disney bought Cap Cities. I said, maybe that changed the business. Post-96, the ratio is about 1.25. I'll make a confession. I looked at those two numbers and I said, what do I do now? I don't know whether that's high or that's low. So what I did was I computed that ratio for all entertainment companies, and that number was about 1.35. I know all these numbers are noisy, they're standard error. Let's take those numbers and see whether we can read something into them. The average across entertainment companies is 1.35, but Disney has a lower number than the typical entertainment company. Finish the rest of the process for me. Would you expect Disney to have a lower beta than the typical entertainment company or a higher beta? Would you expect it to have a lower beta? I wouldn't get too carried away because the difference is small. But if you did this in the airline business, the difference is huge between Southwest and the rest of the airline business. And that's when you're going to say, I would expect Southwest to have a lower beta than the typical airline. Again, something you're going to be able to use later in the process when we talk about an alternative way of thinking about betas. So what business are you in? How much do you have in fixed costs? Last question. How much have you borrowed? Reason being very simple. When you borrow money, you create a fixed cost you did not have until you borrowed the money. At this stage, I'm going to define two different, up till now I've talked about beta as a single number. I'm going to define two different betas, and I'll put some flesh on each definition. The first beta, I'm going to call a levered beta. That's the beta you see for your stock. So it's a levered beta. The second beta, I'm going to call an unlevered beta. That's the beta of the business you're in. Do you see how I'm separating the two? You can have a safe business and risky stock if you borrow enough money to finance a business. And here's the way I'm going to connect them. Don't ask me why Microsoft replaces my betas with question marks. I think in your notes it should be okay. The levered beta for a company, it's the equity beta, should be the unlevered beta, the business you're in, times 1 plus 1 minus the tax rate. I'm going to come back to the 1 minus the tax rate, multiplied by your debt to equity ratio. So let's take the easy scenario. You borrow no money, your debt to equity ratio is going to be 0. Your unlevered beta and your levered beta are going to be the same number. As you borrow money, your debt to equity ratio is going to rise, right? As your debt to equity ratio rises, your levered beta will go up with it. You're saying, what's a 1 minus t doing? It is true that debt creates a fixed cost, interest expenses. But it's also true that interest expense comes with a tax benefit. It's almost like the government is standing next to you and saying, hey, borrow money, it's okay. We'll give you a little break. That 1 minus t captures the break you're getting on your fixed cost from the tax laws being tilted towards debt. So the levered beta is a function of the business you're in and how much you borrowed, net of the tax benefit that's created by that borrowing. Now, when I looked at Disney's regression beta of 1.25, I just called it a beta. But let me ask you now, was that a levered beta or an unlevered beta? The beta that you get from a regression. It's a levered beta, you're right. Now my follow-up question is a tougher one. How the hell did leverage even get into the beta? We just ran a regression of stock returns against returns on a market index. We never looked at debt or equity or any of those variables. It is a levered beta, but how did debt get into the process? And where did it show up in our numbers? Okay, the point that was made, the investors looked at the debt, and the way this shows up is not so much that they look at the debt, but remember what I said debt does? It makes your earnings more volatile, so your stock prices get more volatile. So what you get in your stock returns reflects not the debt to equity ratio you have right now, but the debt to equity ratio during the period of the regression. And this is going to create a bit of a problem. Why? Because even if you believe regression betas, the debt to equity ratio now can be very different than the debt to equity ratio over the last 5 years. We make this specific. Disney's regression beta was 1.25. That came right out, the raw beta from the regression. Its debt to equity ratio during those 5 years was 19.44%. Incidentally, when you do levered betas, you're always talking market value. So market value of debt, market value of equity. We'll come back and nail those two numbers down, but the debt to equity ratio was 19.44%. So here's what I'm going to do. I'm going to do something really strange. I have a regression beta that's already a levered beta. I'm going to take out the effect of leverage from the beta. It's called unlevering a beta. You're saying, why do you need to do that? You want an equity beta? Just use the levered beta. You're going to see in a minute what the advantage is of knowing what the beta would be without the debt. So I take the 1.25, that's my levered beta. I take the 19.44%, which is the average debt to equity ratio during the period of the regression. And I use a tax rate of 36.1% for Disney, which I'll come back in a few sessions. And I take out the effect of debt. I end up with 1.1119. Have you ever watched Jeopardy? It's a very strange show. It took me like 3 years to get used to it. It's a show where you're given the answer and you have to guess the question. Ready? Let's play some Jeopardy. If 1.1119 is the answer, what is the question? And I don't want you to say, what is the unlevered beta? I want something a little deeper than, what is the unlevered beta? What is 1.1119 the answer to? There are two questions I think it can answer. Anybody want to try? Yes.
So what is the beta of Disney if they had zero debt?
First is, remember, debt is a choice. Could Disney have been an all-equity funded company? Yes. So if you ask me, what would Disney's beta have been if they'd chosen not to borrow money? The answer is 1.11. You know what the other question is? What did I say the unlevered beta measures? Measures the risk of Disney's businesses. So if you ask me, what's the risk of Disney's business? Not its shares. The theme park business, the broadcasting business, The 1.1119 measures the risk in Disney's businesses. The reason I like to have the unlevered beta is, do companies sometimes change their debt to equity ratios? Sure, they borrow money, they pay off debt. So if I told you that going forward Disney's debt to equity ratio was not going to be 19% but 50% or 80% or 100%, and you ask me what will the beta be, now I can answer that question, because with the unlevered beta I can tell you what the beta will be at any debt to equity ratio, including an absurdly high debt to equity ratio. You know what a typical debt to equity ratio in an LBO is, in a leverage buyout? It's about 90% debt, 10% equity. Maybe 80% debt, 20% equity. In other words, you're way out at the end of this table. So if you do a leverage buyout, you're KKR, and you do a leverage buyout of Disney, your beta after the leverage buyout is going to be huge, 5, 5.5, 6. Your cost of equity is going to be huge. Not even to keep you happy, just to break even. You will have to make a 30% return on your equity if you do a leverage transaction, because you've essentially taken a safe business by adding on enough debt. You've pushed up the cost of equity. It's a very neat way of kind of dealing with changes in debt and how it affects your beta, and now you can make it explicit. So what kind of business are you in? How much fixed cost do you have? How much have you borrowed? Here's the closing piece that we're going to get this started, because it's going to allow us to get past regression betas. Betas have this incredibly useful property, which is they're always weighted averages. Who the heck cares? What does it even mean? So let's say you're a portfolio manager. You manage Fidelity Magellan. In fact, Bob Stansky, who used to run Fidelity Magellan, was an old Stern grad. So let's say you're the next one in line. You now run Fidelity Magellan. You have 150 stocks in your portfolio. You ask me, what's the beta of my portfolio? The answer is very simple. It's a weighted average of the betas of the 150 stocks, weighted by how much money you have in each one. So you set up a big Excel spreadsheet, take a weighted average, you got the beta of your portfolio. That's not that useful in a corporate finance class, but here's where it's going to come into play in corporate finance. Who did I say Disney bought? Oh, I gave away the answer. Who did I say Disney bought in 1996? They bought Cap Cities, right? Merger. You see lots of big mergers. One of the big questions you can ask is, what will happen to the beta of my company after the merger? Having betas be weighted averages means that the beta for the combined company after the merger will be a weighted average of the betas of the two companies that went in. And I also mentioned GE, right? What did I say about GE? It's in 26 different businesses. If I could somehow give you the beta for each business, say, how the hell are you going to do that? Leave that to me. If I could give you the betas for each business, the beta for GE as a company would be a weighted average of the betas of the 26 businesses. That's the opening we're going to use to get rid of regression betas. So let me do this with the merger first. Okay? So in 1996, Disney decides to buy Cap Cities. This is what the two companies look like in 1996. Disney had an equity beta, which is always a levered beta, 1.15. Cap Cities had a levered beta of 0.95. Disney's market value of equity was $31.1 billion. Cap Cities' market value of equity was $18.5 billion. Disney had $3.2 billion in debt. Cap Cities had $615 million in debt. Let's assume that both companies have 36% tax rates. Here's what I'm going to do before I even get started. I know these two companies are going to come and become one after the merger. I add the debt plus the equity. When you add debt plus equity for a company, these are market values, I get what's called the value of the entire firm. So think of this as the financial balance sheet, the sum of the liability side of the balance sheet. That number is $34.3 billion for Disney, $19.1 billion for Cap Cities. Disney's debt to equity ratio is about 10%, Cap Cities' debt to equity ratio is about 3%. So here's your challenge. These two companies are going to come together. You have to estimate what the beta will be after the merger. First step. I'm going to estimate what the beta for the business will be after the merger. You're bringing together two different businesses. Let's see what the beta of the business will be. I have the levered beta for Disney, 1.15. The levered beta for Cap Cities, 0.95. Remember how I got the effect of debt out of the beta for Disney? I did that for both Cap Cities and Disney. I ended up with an unlevered beta. So this is the beta for Disney's business. This is the beta for Cap Cities' business. So I have 1.08 as my unlevered beta for Disney, 0.93 as my unlevered beta for Cap Cities. Two companies are going to come together. What did I say about betas? They're weighted averages, right? The weights are going to be the market values of the two companies, not the market value of equity alone, but the values of the two companies. So you go back to this previous page, 34,286 is the value of Disney as a company. 19,115 is the value of Capcities as a company. The weighted average beta that you're going to get is 1.026. You're saying, what does that mean? Once Disney acquires Capcities and it becomes one business, the unlevered beta of that business will be 1.026. Now comes the last step. I want a beta for your stock after the merger. What do I need to know to be able to answer that question? Disney has to buy Capcities, right? With what? They're going to come up with the money somewhere. They can come up with it either from equity or from debt. Let's try the easy scenario first. Let's assume they decide to use all equity to fund Capcities. The way this will take, the form this will take is you will give shares in Disney to Capcity shareholders. They'll have to issue $18.5 billion in new equity to buy out Capcities equity. Let's assume that they will assume Capcities debt. Assume basically means you take over the debt. The total debt that Disney will have after the merger will be $3.8 billion. The total equity will be $49.6 billion. The debt to equity ratio is going to drop because you've issued so much new equity. The beta for Disney will be the 1.026 unlevered beta with the new debt to equity ratio. Gives you a levered beta 1.08. Again, you start with the unlevered beta, you look at how the acquisition is funded, you have the levered beta. In fact, Disney actually used $10 billion in debt to fund Capcities. They used $8.5 billion in new equity. They actually ended up with a 34.82% debt to equity ratio, and their levered beta is 1.25. Don't jump to any conclusions. You're saying that's exactly equal to the regression beta I got in 2013. Complete and total coincidence. Okay. I'm going to leave you with the task because I know this requires a little mechanics. Here's a question I'd like you to answer, and I'll send you the answer tomorrow. If Disney had borrowed the entire $18.5 billion to do this acquisition, I've tried two different scenarios, right? All equity, $10 billion in debt. If they'd borrowed the entire $18.5 billion to do this acquisition, I'd like you to compute what the levered beta for Disney would have been after the acquisition. So try it out. I'll send you the answer tomorrow, but that's it for today. I'll see you on Wednesday.
What is the, I gotta come up with some codes for that. Like 2 years from now.
pricing